Welcome to the Hidden Investing Show with Holly Williams. Holly is the founder of KeepMore.com, author of the Hidden Investing book, general partner in over $100 million in multifamily apartment communities. In addition to multifamily holdings, Holly has been a real estate investor for over 25 years. Now here's your host, Holly Williams.
Hello, everybody. Welcome to the Hidden Investing podcast. And I am excited today to welcome my good friend, Danny Randazzo, who famously lost his entire net worth. He was a complete loser at the age of 5.
Yeah.
And that inspired, that was his aha financial moment. Would that be correct, Danny? And so from there, he's going to tell us what's kind of been happening the last 3 decades or 4 decades. I don't know, but has grown started as a consultant. He's been a consultant. He's been a single family home investor. He's been a renovator. He's been now he's a managing partner in passiveinvesting.com. And I started working with them before they were passiveinvesting.com.
That's
so
right.
I'm so proud of everything he's accomplished. So I'm going to let him chat. We're going to have a chat today. Thanks, Danny.
Perfect.
Welcome.
Holly, thank you so much for having me. And, hidden investing really means so much to me because it shouldn't be hidden. These opportunities shouldn't be a kind of whisper trade amongst a small network of people. And, that's really where my passion comes into this as well. So absolutely, at 5 years old, very traumatic experience. My mom was holding on to my wallet before we went into this restaurant, lost it in the restaurant. And that was kind of the tipping point for me of taking responsibility for my money. And it's so important for all of the listeners, all of our investors, every single individual out there. You are ultimately responsible. So just putting deposits in a bank, in March of 2023, while we're recording this, there's been some kind of very interesting banking things that have happened. And, people felt like their money and their deposits at a bank were in jeopardy or uncertain about having access to that money. And so, again, that's why I say it's so important for each individual person to be responsible for their money. And that kind of took me down a road. I read a lot of different books. As you mentioned, I kind of did every investment under the sun out there, both within real estate and within the stock market, and figured out the most control that you can have, the most scalability, and the most, kind of sustainability to a business operation is through real estate, and it's through larger commercial assets. So, a very simple example, if you have one single family home and your tenant moves out, you go from 100% occupancy to 0%. It can be a massive change for your performance of that asset. But if you have a 100-unit apartment community, one person moves out, you go from 100 to 99%. It's not going to be a blip on the radar. Your performance is going to be steady as she goes, as some may say.
It's so funny. It's counterintuitive, isn't it? I've had 2 good friends who are now investors. Well, one of them is. And, as you know, when I first started making phone calls to tell all my friends about this great thing I discovered, they were like, Holly, do you want a job? Do you want me to invest in a market research company that you start? Whatever. But, I've lost money in a land deal a couple of years ago, right? So it's the cash flow part that it's almost too good to be true, right? And I've had one friend tell me, I don't understand real estate. I understand the stock market. And it's like, yeah, right. I know all about Apple's P&L, right? Mm-hmm. And I know all about their, margins. I know what happens to their business. You don't know. You have no idea. And then I've had another friend say, well, if I invest passively, I don't have control over the situation. Right. Meanwhile, he bought a commercial building and he's been in zoning or fights with the city for the last 3 years. So he doesn't have control either. He's learned.
Yeah.
So
well, the way I think about it too is there's really a fine line as a person in charge of your own money, right? You need to think about not only return on investment, but also return on time. So, probably as an individual, the best and highest return you could ever get is if you controlled 100% of a deal and probably did it end to end, spent all of this time fighting with zoning, getting it approved, doing all this. But it could take up a bunch of your time. And so, if you like spending time with your family, if you like going on vacation, if you like what you do professionally as a way to make income, then you can continue to do those things, but you can passively put your money to work in real estate opportunities for that cash flow, for that tax advantage, instead of putting your money in a stock market account or with some broker around the corner in the strip plaza who is equally just as far removed from the Apple P&L as the rest of us. So, I think people, you need to kind of judge like what's your return on investment, but also what's your return on time. And if there can be win-wins in that, then, that's something that fits for an individual portfolio investment.
So you went to school and you worked for Deloitte. Right?
Yep.
You did the whole, let's go to college, get a great job, let's do that. So did your family think you were kind of nuts, or what?
Probably.
How did all that happen?
I grew up in Michigan, and so the auto industry was a huge thing. And my grandmother, on my dad's side, always told the boys, go to college, get good grades, get a good job. Don't ever work in the auto industry, because if they shut down, you'll be out of a job, or if cars or whatever challenge. And so it was so strange to me, because I would walk through walk through the hallway at school, and it was like, this person works at Ford, Chrysler, GM, tier 1 supplier of the auto industry, a tier 2 supplier, but none of my family was in the auto industry. It was weird. They worked a lot for the public utilities. And so in 2007 and 8, for me, it was kind of interesting because I saw these families struggling who were tied to auto. And, our family was a little bit different. So that was my grandmother's thing. Probably just a totally different generational piece. Growing up, going through the Depression, coming through all of the different things happened in the 60s, the 70s, banking in the 80s. But for me, I never really bought into that mentality of, go get a job, get a good paycheck, be comfortable. And I don't think it came for a shock for any of them, because I was always the kid, even amongst the rest of my family and cousins and peers, who was always out working hard. And I think people just knew that Danny was probably a little bit different because he just worked hard. I would move wheelbarrows full of sand that weighed more than I did as a 10-year-old, going down, fixing up people's beaches. I had a neighbor who had a sprinkler irrigation issue and asked me as like a 13-year-old, hey, can you fix it? And my response was, sure. So I spent a few hours out there figuring out how the little sprinkler oscillated back and forth, got to Home Depot, got some stuff, fixed his sprinkler system. And so, I think they always knew like, this kid's just going to put in the hard work to figure it out. And when I was at Deloitte, when I was doing my financial consulting job, I could see how more senior folks in the company exchange their time for their paycheck, right? You can go on Glassdoor, you know what they're getting paid. And I was like, hey, this probably isn't for me because I can put in exponential amount of effort and my return is capped in the bonus or the paycheck or the pay raise. And so I kind of said, hey, look, I got to do something different. I know all about this real estate. I know about this entrepreneurship hustle, and I'm going to go and do that.
So how much did you get paid to fix the sprinkler?
I was probably charging at that time like $20 an hour. So it probably took me a few hours to figure out how it worked, a few hours to fix it. I probably made $100.
Right. So you need to, that's where you learned about value pricing, right?
Value pricing, but
what would it have cost him to replace the sprinkler system versus what you did to fix it so he didn't have to buy a new one?
Definitely. The other big important thing there is understanding the value of a dollar. So,
right.
All of us as, income generating individuals, if you think about it that way, we work really hard to make money. And so it's so important to protect that money. That lesson I learned as a 5-year-old, I didn't protect my money and I lost it. So it takes a lot of time, effort, energy, sacrifice to go out and make $20, make $100. And so it's really important that you can store it, you can protect it, and you can have it grow.
So how do you, when you passively invest in a deal, how do you ensure, how do you make your investors feel okay with you having control, right, of that?
I think it's something that we've naturally built over time. An investor will invest money with people that they know, that they like, and that they can trust, and trust being the most important piece. And so people know us, people like us, and people trust us, and that builds slowly over time. I would never ask a new person to put a chunk of money in without spending some time getting to know us, getting to see what we've done, what we're doing. And another equally important piece is that we invest alongside our investors in every deal that we do. Typically, between my business partner, Dan, and myself, we're probably the largest single individual investor in each deal. And so we believe in it tremendously. We put our money into it just as much as all of these passive investors do. And so there's a great alignment of interest that really builds that trust component as well. And so I think knowing who the operators are, knowing how they think about the business plan, there's going to be ups and downs. There's going to be challenges with the economy outside of our control, right? Just like we've seen over the last year with interest rates rising, the Fed hiking things up, the banking industry being a little bit different at the moment. There's going to be challenges to that, and you just need to know what that alignment of interest is with the operator and with your personal investment. And so, if you're investing in a multifamily deal, you should have a long-term expectation for that investment, just like we do, right? It's an illiquid investment. You can't sell it tomorrow like you could the stock market. And so you should not be investing your kind of emergency savings and reserves into a multifamily deal. You should be investing capital that you won't need access to for several years. And with that long-term approach, you can weather these short-term obstacles that pop up along the way.
Right. I know that we've moved to quarterly distributions, and I tell investors, it's hard to see a trend in a month, right? And you want to be with operators that are being conservative, and let's make sure that the seasonality, that that it's not seasonality, or it is seasonality, or it's different. You can't tell if this market is different than it has been in the last 3 years. relative to rents and migration and all of that if you just look at a month. So there's things like that my they shouldn't be there will be a Christmas, right? Don't put that money into any real estate investment that is illiquid.
I agree.
So yeah. So what do you think? Tell us a little bit about how you're seeing the economy. I know that and how passiveinvesting.com has gotten into car washes and really expanded beyond hotels, expanded beyond multifamily. How do you tell us a little bit about that?
Well, I think again, it really comes back to that personal responsibility for your money and your own portfolio management. And so, as we think about different areas to place your money to protect it and have it grow, there's different levels of stability or risk and returns that you can hit. And so going from multifamily, adding a little bit of a storage opportunity was a very straightforward kind of growth strategy for us. The self-storage market typically yields a little bit higher cash flow, a little bit higher return, just because people aren't living there. So there's an inherent kind of, added component of uncertainty of, if the economy goes bad, will people continue to store and pay for their stuff? Over the course of history, the answer to that is yes. People really love their stuff, so they continue to pay for it.
We like our stuff.
They like their stuff, and they got a lot of it. So storage was a pretty easy, straightforward opportunity. Our lending business was a natural fit that we launched during COVID. We had many, many years of lending money on the side to these fix and flip rehabbers. But during COVID, we saw this need from investors of a short-term area to put your money. So I talked about multifamily being long-term, self-storage is long-term, hotels are long-term, express car washes are long-term, right? You put your money in, don't expect it back for several years. To the flip side of that, people said, hey, we have this extra money in our checking account. Hopefully it's not more than $250,000 worth, but if it is, put some of that money into our lending business. Have your money, instead of sitting in the bank earning, very little, have it in a place where it's protected. It's in a first lien position. We're giving low leverage loans to these people, and they're paying interest. And so we're generating income on a monthly basis. And with that, with short-term loans, we can recycle that money very quickly, where there's a liquidity option for investors. So you have the ability to get your money back within days or weeks at a time, as opposed to having it locked up for many, many years. And so that business was just a very straightforward balancing the individual investor's portfolio. You should have a long-term bucket of money, you should have a short-term bucket of money, and then you should have your kind of emergency reserves bucket of money, or, cash or something that can be traded very quickly in the event that you have, an emergency situation come up. And so that's where the opportunities really came, a little bit of diversification in opportunities, allowing investors to be in a multifamily deal, to put some money into a car wash opportunity where, again, the cash flows are a little bit higher, the returns are a little bit higher, and each investor can kind of pick and choose what is right for them as deals come up. Also, it was kind of lucky for us in terms of getting into these different asset classes a year and a half, kind of 2 years ago, where over the last 18 months, the multifamily industry has been pretty slow. as we've seen interest rates rise, sellers and buyers have a bit of a gap in terms of where they want to sell at and where people want to buy at, and how the interest rate kind of fits into that. And so, if people are still making money, having extra money that needs to be invested, you can't just sit on the sidelines for a long period of time, because money that's just sitting there is dead money and it's really costing you. And so being able to deploy it into different opportunities as they come up is a very useful tool to have. It really comes down back to the hidden investing opportunities that are out there. So it just created new avenues for people to, securely invest their money, have it protected in a property, in a real asset that can't go away, that share price can't, drop by 90% in 20 days. So we've really enjoyed it. I think as we think about, business and long-term success, that's how we really got into these different asset classes. And, we kind of got lucky with a challenging global economy and, being able to provide different investment opportunities when, the bread and butter multifamily was a little bit slower.
And I tell my investors that you have to be in all of this. I'm a big believer in the life insurance. So, I learned it's all about the velocity of money, which you just talked about, right? And I learned, these sleazy life insurance salespeople, there are, but what people don't understand is that life insurance is how the wealthy have protected their money for all modern times, right?
And there's some really great people in the life insurance business too. I'd be happy to share a reference should anybody need one.
I went and got a real estate license, a licensed life insurance. I believed in it so much, and it is just, there's that and the debt fund. I work with you all on, and you handle all the back end. I'm a part of your debt fund, and really proud to be able to participate in these life-changing opportunities, because you are exactly right. Every minute that the dollar sits in the bank, and the bank doesn't have the dollar, that's what people really don't understand.
Yeah, well, the other thing too is, the banking industry, it's kind of like the Apple P&L. It's a little tricky to understand, but the bank, they can't really sit on the dollars either. They need to be making some sort of money on it, and the regulators kind of force them to do these certain things and not too much of this and not too much of that. And so, as we saw with the Silicon Valley Bank, they put all of their money mostly into these bonds, and then interest rates went the other way. And so the bonds were not worth quite what they needed them to be at the time that they were forced to sell them. So it's a challenging place. And that's why I say, your money needs to be deployed. You need to control it. So if you need long-term opportunities, we've got those. If you need short-term opportunities, we've got those. And the best part is the money is all protected by a real asset that's out there.
So you have a beautiful wife, Caitlin. You have 2 beautiful children. You live in Charleston, South Carolina. That's where Caitlin is from, right?
Yep.
So we talk about lifestyle changes and demographics and all of those things that I spent my 30-year career in advertising immersed in. How has the Danny moving from single, then double income, no kids, and then now you've got the two kids and the dog in the backyard? I'm sure you've got a swing set, all of that stuff at this point, or you're getting there. Not there yet, but
getting there. Yep.
You got a sandbox at least or something, right?
We got a single swing in the yard right now.
There you go. Okay.
A larger swing set on the way.
There you go. There
Yes.
you go. So how are you navigating all of that? And how should people think about that as they look at these buckets of money with long, short,
For
emergency?
me, I'm in the kind of younger end of the age range, right? I'm probably in that first third. If you think about if people live to be 100 or so, or 90, whatever, you got
Mm-hmm.
kind of the first 30 years, your middle 30 years, which is your kind of prime working, income generating, planning for retirement, and then your last 30 is, you know, being in that retirement. So I'm still in the growth mindset. And for me, the transition, I grew up in Michigan, lived in San Francisco for a period of time, moved to Charleston, absolutely love Charleston, really love the Southeast US. We invest heavily here. There's reasons for that, basic demographics. People are moving here. People are bringing their high paying jobs from the Northeast and living in the Southeast US. The economy is very good. There's diversification amongst employers. Employers are growing here in the markets, and people in our population is growing too. So we've got a great little insulated economy here. So that's been great. The people here in Charleston are wonderful. We've got a very easy pace of life. I joke with people, I probably drive on average 1 mile per day. Um, I can walk from downtown. I work from the home, so that makes it easy. There's no commuting. There's no lost time in traffic. Um, I think life is always a balance of different priorities. And, for me, there's really kind of two priorities. There's family and there's work and business. And I love both of them. So for me, doing this podcast with you is easy. It's fun. It's enjoyable. Talking about property performance, it's easy to do. It's fun. You might have challenges to overcome, right? Harder months than others, but it's all part of, doing what we do. And so, for me, the lifestyle is great. It's a balance of the two. I don't think you're
That's right.
ever perfectly in harmony. Some days require more business focus. Some days it's more family focus, but there's a reason why, again, we do what we do. The other beautiful part about real estate in its purest form is it doesn't move that quickly as the stock market. So, hopefully I don't wake up one morning and all of a sudden real estate prices across the country have plummeted by 30%. But in the stock market, you could have one news piece that catches and all of a sudden you have a disaster to deal with. And so, I think that's part of the reason why I enjoy real estate as well. It's just a little bit slower moving. Time is on your side if you can kind of weather those obstacles that pop up along the way. So, really enjoyed the balance. Certainly struggle with it. I'm a human at the end of the day. Some days I am doing more work than the family thinks I should be doing, and other days I'm probably doing less work than the family thinks I should be doing. So, we're loving life. We enjoy the family. We enjoy walking in Charleston. Every morning we get the kids in the stroller. We walk and get our coffee. We come back and we get ready for the day ahead. And so, I think my dad gave me the advice that while your kids are kind of in this under 4 or 5 year old range, it's kind of like Groundhog's Day. You're going to kind of wake up and do the same thing every day. And so, we just enjoy the laughs, the cries, the smiles, the tears as they come and roll with it.
Well, I think that's what you have to do. And I also think that the whole idea of the whole, first, third, second, third, I don't ever, and I think you're probably, when you're my age, my guess is that you're going to think a lot more like I do. Like, I'm just getting going. I'm having a good time, right? This
Oh,
is
for
not
sure.
work. This is not work.
Yeah.
And yeah,
Yeah, I really enjoy it. The other thing too is like there's this snowball effect. So as people invest in deals over time, I would not encourage someone to take all of their money and put it into one deal, right?
put it
But
anywhere.
get a deal, get a next one, get the next one, get the next one, and before you know it, you've got. I always visualize the snowplow trucks.
That's right.
So they get started, right, and then before you know it, you have dollars kind of overflowing your investment. You're plowing along, and then you need another plow to start to grab that, and so you can build on it. And so, this is not a get rich overnight kind of thing. It's a build long-term wealth slowly, methodically, safely over time.
That is correct. And a lot of the Silicon Valley, and I grew up in ad tech. That was my business I was in. And they want to invest in 10 companies. They want to get on the board. They want to, 9 of them will lose big. 1 of them will hit.
Yeah.
And this is not that. But
Yeah.
every deal that I do over the last 10 years, a couple of friends of mine from the early AOL days or whatever will finally call me and they'll go, okay, now wait a minute. What are you doing now? Tell me about this real estate thing. Because,
Yeah.
Pedestrian sounds really good as you get a little older. Right?
Mm-hmm.
Anyway, so I hope that we all live to be 100. I can't wait to see what else you're going to do, Danny.
Thank you.
I really can't. And I'm very, very proud of all you've accomplished. And I'm coming to Charleston soon to visit.
Beautiful. Would love to have you.
It's a wonderful place. Thank you so very much. Anything else that you'd like to live? One more thing. I know that you've written 2 or 3 books at this point. I know you've written 2 children's books.
Yep.
Right?
Correct.
And you and Kelly wrote
Correct.
a very interesting book recently.
That's
And
right.
That's a good one. What else you got?
We have another book coming out. It should be coming out, any month, maybe over the next few weeks into the next month. It's going to be all about apartment investing. We've been working on this book for a little over a year now, so we're excited to have that hit the printer and be ready to go. Books are great. I love to read. I enjoy to write and share just the lessons I've learned. It's important to, remember with real estate, right? We're not doing anything different than hasn't been done before. And so in the community, if you're facing a challenge, someone else has gone through that before, and you can really find some very helpful people, friends, mentors in the space to help you overcome those challenges. And so, that's kind of what we shared in that book for anyone who wants to be either an active operator or really helpful tips on how to be a good passive investor, how to vet operators, how to know how operators work. And it's going to give you the opportunity to ask some very good questions if you're thinking about investing in any deal that's out there.
Well, I think this is God's work, because I think it's a damn shame that we don't learn any of this in business school. We really, really don't learn about how money really works. And so I thank you. I've learned a lot from you over the years. And
thank you.
And we will keep learning. So thank you, everybody. And thank you so very much for helping me get my new podcast going. And
so happy to be here, Holly. Looking forward to seeing where you go with it.
So much fun, right? Talk soon. Thanks,
all right.
Everybody.
Thank you.
Thank you for listening to the Hidden Investing Show. If you enjoyed this episode, be sure to rate, review, subscribe, and pay it forward by sharing with your friends and family. To get an exclusive gift, visit hiddeninvesting.com.